Today on Go Ahead Ask, wondering about qualified opportunity zone investments? What are they? Are they right for you? Do they work with 1031 exchanges? Let's unravel that on Go Ahead Ask.
Building wealth in real estate? Let the Exeter Group take the mystery out of how it's done on Go Ahead Ask.
Welcome to the Go Ahead Ask podcast by the Exeter Group. We unravel the mysteries of investment real estate to provide investors with better quality information so that you can make better informed investment decisions. I'm your host, Bill Exeter, for today's podcast. The Exeter Group of Companies includes Exeter 1031 Exchange Services, which is a qualified intermediary for 1031 exchange transactions. We administer all type of exchanges in all 50 states. We also include in our family of companies Exeter Trust Company. They administer self-directed IRAs and individual 401ks, as well as title holding trusts, also called land trusts, specialty holding escrows, and custody services. On Go Ahead Ask, we encourage questions, so please email questions, topics, or even if you'd like to appear on the podcast, to ask@exeterco.com, or you can call us at area code 619-239-3091. If you like or even love Go Ahead Ask, share it, subscribe to it, like it. It would certainly help us out. Today, we're unraveling the mysteries of qualified opportunity zone investments. One of our listeners had asked, about the qualified opportunity zone investments, and rather than address the listener's question, we thought, what a great topic for the podcast today. So we're going to unravel that mystery today. And with us today, we have a guest expert. David Levinson joins us. And a quick introduction to David. David Levinson is a 1031 exchange property specialist with American Trust Investment Services, located in Newport Beach, California. He's a financial advisor with 40 years of experience, holds a Series 7 and Series 24 securities license and registered principal licenses. He has specialized in 1031 exchange replacement property since 2000, and he's conducted due diligence on opportunity zone investment funds since the inception in 2019. And we've been working with David for a number of years, so I can't even remember when we first met, going way back when. So David, welcome to the podcast today.
Thank you, Bill. We did our first transaction together in 2014.
5-6 years now. That's amazing.
Yeah, that was our first deal, was still our biggest. That was $68 million.
And that's probably why I've lost a little hair here. So, we get a lot of people calling us and asking us about the qualified opportunity zone investments. Maybe give us a little background on, what is it and how does it work?
Well, an opportunity zone is an economically distressed community where private investments under the proper conditions may be eligible for capital gains tax incentives. Their purpose is to spur economic growth and job creation in low-income communities while providing tax benefits to the investors. Opportunity zones were created under the 2017 Tax Cuts and Jobs Act, signed into law by President Donald Trump on December 22nd, 2017, to stimulate economic development and job creation by incentivizing long-term investments in low-income neighborhoods.
And how many opportunity zones are out there? Is that something that's relatively easy to find? How would an investor kind of help narrow that down?
Well, there are exactly 8,760 designated qualified opportunity zones. They were chosen by the respective governors, both of the states and also the District of Columbia and 5 United States territories. And the opportunity zones were designated at the beginning of the program. And I expect over time they can be changed, but we're still using the original set of 8,760.
What do those opportunity zones look like? Would anybody recognize them? Are they all in the economic underdeveloped areas?
Well, the purpose of the opportunity zone is to encourage development where it's needed, to create jobs where jobs have been lost. They are not necessarily just low income areas. Surprisingly, many downtown areas of many major US cities have been designated opportunity zones because the governors felt that they needed more job creation in those areas. So, again, the purpose is to create new construction of property and to create new jobs in the neighborhood.
And one of the things we get asked a lot about is by clients who are in the middle of a 1031 exchange, and they ask if they can buy a property located in the qualified opportunity zone as part of their 1031 exchange. So can you kind of maybe go into the differences between a 1031 exchange versus the qualified investment opportunity zone?
Well, obviously, in a 1031 exchange, one must hire you, their qualified intermediary, and all of the proceeds of sale flow directly to the qualified intermediary. And of course, the investor cannot receive the funds. Now, normally in a 1031 exchange, one can elect to receive what's called boot or taxable income. In other words, you can do a partial exchange and do an exchange on a portion of the funds and receive the remainder of the funds. And of course, you would have a prorated capital gains tax on those monies. But then you can take that additional money and invest it in an opportunity zone fund and have reduction in capital gains taxes on that portion. So yes, one can do a combination of a 1031 exchange and an opportunity zone fund, and I think that's a great idea.
And perhaps touch upon maybe a failed 1031 exchange and how an investor could jump on the qualified investment opportunity zone to kind of help them there.
So the deadline to invest in an opportunity zone fund is your monies must be received at the fund within 180 days of the date you closed on the sale of your property. So that if one had those funds go to a qualified intermediary and they failed to identify the replacement properties or partially fail during the 45-day period, then again, they could have the qualified intermediary distribute the funds which were not going to become part of the 1031 exchange. The investor would receive those monies, which would then, of course, become taxable under the exchange, and then invest in the qualified opportunity zone. So investing in an opportunity zone does not require any intermediary at all. The investor does it himself, and their CPA places the investment in the opportunity zone fund on their tax statement, the capital gains portion of their income tax return for that year.
And you hit the key word there, which was fund. So for those investors who are looking to sell, do a 1031 exchange, and then buy an opportunity zone as a replacement property, that can't be done because they'd be buying into a fund, which is typically a partnership interest. So it wouldn't qualify. So it really comes into play exactly the way you spelled it out, where it may be leftover proceeds that become taxable boot or even a failed 1031 exchange. Otherwise, if they're going to have a successful 1031 exchange, they'd have to buy replacement property directly as opposed to a qualified investment opportunity zone fund.
Right. The opportunity zone funds always involve new construction. New construction offers higher opportunity for growth, but always also higher risk. So I see a great use in that, especially on a larger 1031 exchange, one diversifies a portion, maybe 10 or 20% of the funds at the qualified intermediary could go into the opportunity zone fund outside of the exchange, and then they complete the exchange with the remainder.
And can you go into specific details on exactly how the qualified opportunity investment works?
First of all, you don't use a qualified intermediary. You just close your sale and receive the money. Working with a financial advisor who has an expertise in opportunity zone funds, you select one or more funds to invest in. Whenever possible, we recommend that one diversify into multiple funds if a sufficient amount of money is available. You only invest an amount equal to the capital gain in the asset you just sold. Again, you just invest the amount of the capital gain. Any amount that you would invest over that amount will not have the tax benefits of the Opportunity Zone Fund, and most funds won't take it anyway. Then at the next April 15th, your accountant will report this investment on your tax return capital gains schedule, and the payment of the capital gains tax will be deferred until December 31st, 2026, and no interest accrues on the unpaid tax amount. If you invest in 2020, you also receive a 5% reduction in the tax that you pay in 2026. I suggest that you set aside the tax amount now to pay the tax in 2026. Many, but not all states also participate in the capital gains tax reduction. So since this video is going out to all 50 states, the investor should ask their CPA or ask me whether or not their particular state provides reductions in the capital gains tax based on opportunity zone funds. The fund will build new buildings and opportunity zones, and then the units will be rented out. Around year 4, you should begin to receive monthly cash flow from the rental income. After the buildings are fully leased, the fund may choose to place financing on the properties and return tax-free cash to the investors. This is not guaranteed and is not a feature of all funds, but some of them. And it is, of course, subject to market conditions at the time.
And it's interesting that you noted that most funds will not accept money that is not directly tied to a taxable gain. So it has to be a taxable gain amount that they invest. And if it's above and beyond that, they just won't accept that?
Well, legally they can, but many of them just choose not to because it becomes very difficult from an accounting standpoint, because the tax advantages to the investor will only apply to the original gains amount. So most people just invest the gain, and then they take the original corpus or return of capital portion and invest that however they wish.
So that's really an important point for investors who are maybe doing a 1031 exchange, and maybe the exchange is a $5 million sale and it fails. If their taxable gain is only $1 million, all they'd have to reinvest through you would be that $1 million.
Right. Or an investor with a large exchange that wants to receive some cash back. This is just a wonderful way to take care of the capital gains tax for the cash back portion rather than just pay tax on the whole amount of boot. So the fund will hold the properties for 10 full years. That's an important feature of Opportunity Zone funds. They are a 10-year hold. That's required by the statute. After 10 years, they will begin selling the properties and return the sale proceeds to the investor. The investor receives a 100% step up in basis at the sale of the property and owe no federal capital gains tax or recapture of depreciation. So this elimination of the capital gains tax occurs only after 10 full years of holding the property. If the property is sold in less than 10 years, partial tax benefits are granted, but every Opportunity Zone fund intends to hold the property for 10 full years to receive the full elimination of the capital gains tax.
And that full elimination is only on the new property or new investment in the Opportunity Zone Fund. So the current gain that's being deferred by buying into the fund is only deferred to 2026. Is that right?
Yes, December 31st of 2026. So let's go ahead and pull up my hypothetical spreadsheet and let's watch how the cash flows work, and we can see when those taxes are paid. So notice here that these numbers are hypothetical. This is not a projection of actual returns. And these numbers do not include any state capital gains taxes, which may be due because each state is different. So here we have an investor investing $100,000 of capital gain, and I compare investing that $100,000 into just a regular investment in an Opportunity Zone Fund. So right off, you see that the regular investment, the capital gains tax, federal tax, capital gains tax at 23.8% is deducted. So that's a deduction of $23,800. Also, there may be recapture of depreciation on top of that. And so the after-tax investment on the regular side is $76,200, whereas the full $100,000 is invested into the Opportunity Zone Fund. And then we hypothetically grow that amount for 5% a year appreciation. Again, this is just a hypothetical case. And we see at the end of 10 years that the regular investment grew to $124,121, whereas the Opportunity Zone Fund grew to $162,889. Out of that, the regular investment again pays another capital gains tax of $11,405, leaving them an after-tax balance of $112,716 compared to the $162,889 at the Opportunity Zone Fund. And then in December 31st of 2026, the Opportunity Zone investor pays the deferred tax from the original sale. In this case, it was reduced from the original $23,800 down to $16,660. And so the after-tax net of the regular investor, he nets out at $112,716. And so he's only made $12,716 after suffering from 2 episodes of capital gains tax. The Opportunity Zone Fund investor nets out at $146,229. And so his 10-year gain was $46,229. So he ends up with 36% more money than the taxable investor in this scenario. In addition to this, both investors will receive income from their real estate investments, but the income on the Opportunity Zone Fund side will always be 23.8% more money because that'll be income based on $100,000 invested and not $76,200 invested.
This episode is sponsored by our sister company, Exeter Trust Company. Did you know that all individual retirement accounts are self-directed IRAs? It's because you choose where to put them. You choose whether to put your self-directed IRA at a bank or at a securities or brokerage firm or a life insurance company. So that makes it self-directed. But did you also know that all IRA custodians are not created equal? Most IRA custodians, like the banks, the securities firms, and the life insurance companies, limit you to publicly traded investments such as stocks and bonds and mutual funds. But some IRA custodians, like Exeter Trust Company, allow investors to invest their IRA funds in other alternative assets such as real estate. Investors can acquire real estate, mortgages, deeds of trust, or tax lien certificates inside the IRA as an investment inside the IRA. To learn more, call Exeter Trust Company at area code 307-222-8750 or visit them on the internet at exetertrustcompany.net. And we've seen a lot of stuff obviously is going on today in this world with COVID-19. And so with that, what type of property types are available for investments through the qualified investment opportunity funds?
The only kinds of properties which are disallowed from opportunity zone funds by statute are golf courses and country clubs. They're specifically excluded.
Really?
But, yeah.
It's interesting that they would carve out just those two property classes.
Well, it may have been political.
That's a good bet.
But the feeling was that golf courses and country clubs don't benefit the local working people very much, and the primary purpose, is to improve the community and to create as many jobs as possible. So an ultra luxury hotel is perfectly fine, because hotels employs lots and lots of people. So probably one of the primary uses in opportunity zone funds are apartments, and that's my favorite property sector at this time. In fact, our various opportunity zone funds that build apartments contain many of the top 25 largest builders of apartments in the United States. However, there are also opportunity zone funds that build hotels, build office buildings. We also see mixed use complexes, which are typically a combination of apartments along with retail, usually at the ground floor, and some office. There are also retail opportunity zone funds, but I haven't seen any currently, probably because of the distress in the retail area right now due to the COVID situation. Mm-hmm. Also, there are opportunity zone funds that only have one property, and the benefit there is you know exactly what you're investing in, and it might be a special situation, and you might have a higher potential return, but also a higher risk because there's no diversification. The multiple property portfolios typically diversify among 5 or more properties to reduce the portfolio risk, and that's what I favor at this time.
And can you comment on the difference between the qualified investment opportunity zone versus other replacement property options for a 1031 exchange like the Delaware Statutory Trust?
Well, Delaware Statutory Trusts almost never invest in new construction. In fact, I've never seen it. There are various requirements of DSTs which make it very inconvenient to do new construction or even to do rehabilitation beyond a certain point. So DSTs always invest in existing property and they don't take construction risk. They also offer cash flow beginning immediately. Opportunity zone funds always involve new construction because that's what they were created for. They're created to provide new economic activity in depressed areas. So these funds always involve new construction, and we have to wait for the property to get built and to be occupied by tenants before we begin receiving income. In addition, the opportunity zone fund cost basis is typically 25 to 35% below the purchase price of an existing property. This is what we call the developer's profit. This should provide higher monthly income and opportunity for higher total return than investing in existing properties. And then, of course, we have the multiple tax advantages on top of that developer's profit. In addition to the tax benefits, one has the satisfaction of knowing that they are contributing to the redevelopment of challenged areas in America.
But just kind of made me think about it too. What's the minimum investment required for these type of funds as well? Does it come down to a pretty low level amount, or?
No, it's usually $50,000 or $100,000, and many of the funds that have a 100,000 minimum, especially when we're trying to diversify into multiple funds, will usually take the 50,000 on a special request from the investment advisor.
And along the same lines, so if a client's interested in investing through the qualified investment opportunity funds, what's the best way? They sit down with you, and then how would you help them kind of decide what to invest in the OpZones?
Well, there are opportunity zone funds that are sold direct on the internet. These do not go through the due diligence process, and there the investor speaks directly with the developer. Obviously, I represent a broker-dealer. I'm a registered financial advisor. So the client would either sit down with me or work with me on the phone, since we're not doing a lot of in-person travel these days. And I would get to know the investor, understand their situation, and I would also verify that they're an accredited investor. These investments can only be sold to an accredited investor, and by definition, that's somebody with a net worth of $1 million or more, not including their primary residence. So I need to understand their suitability characteristics and also verify that they're an accredited investor. And then I'm able to send them specific opportunity zone funds for their perusal, so that they can decide which of these they wish to invest in. Another thing I like to do is to arrange a conference call with the investor and an officer of the opportunity zone fund, many times, for example, the acquisition department or whatever, and give the investor an opportunity to speak with the company itself. We find that very helpful to allow people to make a comfortable decision.
Good job. And with that decision process too, what are the deadlines involved with that? I know you had mentioned too that there's a certain benefit if they invest by the end of this year in 2020.
Right. So the investment must take place for an individual within 180 days of the date they sold the property that they sold. If the entity making the investment is a C Corp or an LLC or some business entity, they usually get 180 days from the end of their fiscal tax year, so they typically get a little longer. But if the investment is made in tax year 2020, then the capital gains tax, which is paid on December 31st, 2026, is reduced by 5%. If one invests in tax year 2021, that 5% reduction is no longer available. However, all of the other tax benefits still apply, and we expect a very active year in 2021 for investors investing in opportunity zone funds.
So effectively, if they invest in 2021 or later, then they won't get any step up in basis or forgiveness, if you will, of the capital gain for the current asset, but they would still have all the benefits of the qualified investment opportunity zone gain on the back end.
No, not quite. The only difference is that the 5% reduction on the tax owed goes away. All of the other tax benefits still apply. When you buy an opportunity zone from an investment advisor, from a broker dealer, then that investment is subjected to two levels of due diligence before the investor even sees it. First, a specialized law firm is engaged to create third-party due diligence reports. And then those reports are sent to the broker-dealers and examined by the broker-dealer's own due diligence department, which in the case of my broker-dealer includes me. And we have a full-time staff doing due diligence. And so we then create our own internal due diligence report on top of the third-party report. We typically interview the companies and the specific people on the particular fund before making our final vote of our investment due diligence committee. Our due diligence director in Chicago has 22 years of experience, and I have 40 years of experience. Only after that amount of study are we able to show the investments to accredited investors. If one buys a qualified opportunity zone fund directly from a sponsor on the internet, rarely, if ever, is there any due diligence at all on those. So those investors are on their own.
Gotcha. And you mentioned before a little while back about suitability. So what situations would arise where an opportunity zone fund might be perfect for an investor, might give them some great benefits, and when would they may not want to even look at a qualified investment opportunity zone?
Well, an opportunity zone fund is a 10-year investment. So somebody looking to invest for a long time horizon of 10 years or more might find the fund interesting. So for example, if one wanted to set some money aside to pay for their grandchildren's college education, the Opportunity Zone Fund could be a very good fit. On the other hand, investors who were conservative, where new construction represents more investment risk than they're comfortable with, then the Opportunity Zone Fund would not be suitable for them at all, because they always involve new construction. Also, the Opportunity Zone Fund is illiquid. You can't sell it until the fund closes down. So investors who require liquidity in the first 10-year period, the Opportunity Zone Fund would not be suitable for them. So there are quite a few other situations where an Opportunity Zone Fund might benefit an investor. It used to be that we could do 1031 exchanges on many different types of appreciated property. And then in, I believe, 2016, they changed the rules where 1031 exchanges are now only available for real estate. And so the first example would be the sale of one's primary residence or vacation home. You cannot do a 1031 exchange on your primary residence or a vacation home or any other house that you own that's not a rental. And in selling your primary residence, there's usually a $250,000 exemption for single people and $500,000 for married people, exclusion from capital gains taxes. If the amount of capital gains is higher than that, then those investors could invest that excess gain over the exclusion amount into an Opportunity Zone Fund. Another great opportunity is the sale of appreciated stock or appreciated mutual funds, which are not held in a retirement account. Many people would like to take profits on some of their stocks and to maybe reallocate their stock portfolios. And this is an opportunity to do that and to reduce the capital gains tax and redeploy those assets into new construction real estate. Also, the sale of a privately held business or partnership. Many times in the sale of a business, there is a real estate component, and that real estate component can certainly be used in a 1031 exchange. But the remaining gain of the remaining value of the sale of the business can be invested in an opportunity zone fund.
And that's the area where you had mentioned that the deadlines may be a little longer than the 180 days because it might be a partnership or a business, some type of a corporate entity.
Yes, anyone with an entity considering an opportunity zone fund should contact me, and I will tell them what the specific deadline would be for their specific entity. But entities always get more than 180 days. They're each a little different. Also, the sale of a real estate limited partnership or LLC or real estate investment trust. And while these are all real estates, they're not candidates for a 1031 exchange, but they're excellent for opportunity zone funds. Also, the sale of appreciated commodities, the sale of appreciated collectibles and art or collectible cars, the sale of highly depreciated business equipment and aircraft. So, for example, let's say your business owns a Cessna Citation jet, and you're about to sell the aircraft, and while the sale price of the aircraft is slightly below what you paid for it, you've totally written off the aircraft. It's typically 7 years depreciation. So almost all of the sale proceeds of the aircraft, which has not gone up in value, but yet all of the sale proceeds are capital gains. Well, all of that money could be invested into an opportunity zone fund. Another great opportunity is the sale of a family farm. Many times the sale of a farm is a combination of a 1031 exchange for the real estate portion and also a taxable portion, which represents the business of the farm and the primary residence. That always has to be carved out of the overall exchange. But again, that portion, the capital gains of that portion can be invested into an opportunity zone fund. But now I've saved the best for last. In fact, literally all of the opportunity zone funds that I have been involved with so far have involved failed 1031 exchanges, where for one reason or another, the client was not able to find suitable replacement property in the 45-day identification period. And so if you fail to complete your 1031 exchange, you can still invest in the opportunity zone fund as long as your money arrives at the fund within 180 days of the date that you sold the original property. So be sure and wire the money. Don't put the check in the mail. And the return of capital portion, the portion that is not invested in the opportunity zone fund, you can invest, you can put that in a bank account, you can put it in a real estate investment trust portfolio, or you can put it in for your college education for your children, or buy a new Lamborghini.
Perfect. And so investors can get in touch with you and ask more detailed questions. What's the best way for them to get in touch with you?
My phone number is 949-903-3455. I'm in Newport Beach, California. So I ask our friends on the East Coast to please wait and call me after lunch, because I don't answer the phone at 6 o'clock in the morning. Also, my email address will be up on the screen for people as well.
Well, you've been listening to David Levinson, a 1031 exchange property specialist with American Trust Investments out of Newport Beach, California. And David, thank you so much for joining us today. That was a lot of great information on qualified investment opportunity zones.
Thank you, Bill.
And thank you for listening to the Exeter Group's Go Ahead Ask podcast. Don't forget, we always encourage questions or topics that you'd like us to cover, or even if you want to appear on the podcast. So email your questions to ask@exeterco.com, or give us a call at area code 619-239-3091. If you liked or loved the podcast, like it, subscribe to it, share it, please. You can reach it at Facebook /Go Ahead Ask Podcast. Our next podcast is going to be on different types of tax deferral strategies. A lot of people look at the 1031, but they've never looked at 1033 exchanges or 721 contributions or the 121 exclusions, seller carryback notes, etc. So we'll unravel that on our next episode of Go Ahead Ask.
Thank you for listening to Go Ahead Ask with the Exeter Group. Join us for our next episode when we further unravel the mysteries of real estate.